Hey, I'm Mike DeSepoli, and welcome to the Heritage Market Update for Wednesday, January 5th, 2022. We hope you all had a great day today. Market certainly did not have a great day today. You see the headline there on the screen: Hawkish Fed sparks tech rout and Treasury sell-off. Let's take a look at our major markets here today and give you some context around some of the moves we're seeing. Dow Jones down over 400 points today. S&P down 92.96, and the Nasdaq leading the way down 522 points. It is natural anytime we get interest rate fears to see pressure in the Nasdaq exceedingly more than the other indexes. So let's talk about what happened today, why the markets are selling off in their worst fashion since March, and how this setup reminds us very much of February, March, and April of 2021, and how that we think this will resolve themselves. So everybody's concern right now in the market is that interest rates, the Treasury yields, are moving higher, right? After a low in early December around 1.3, Treasury yields have moved up to 1.7. Now you might be wondering, well, why do I care? Well, the market's barometer for interest rates is the Treasury, and there's a fear that if the Treasury yield starts to move too quickly higher, the Federal Reserve will be forced to raise interest rates. Now, say it with me. Higher rates are not bad for stocks, okay? Higher rates are not bad for stocks. I want you to remember that, because when we zoom out and we look at yields that have for the last 40 plus years, right, a very repeating pattern, which has yields moving lower really since the late 70s and early 80s, okay, this is a pattern we expect to see continue. Short term, sure, rates can move a little bit higher. And if they do, if the Treasury yield goes to 2%, 2.53%, that is still an environment that stocks can succeed in, right? Just look a couple short years ago, back in 2013, 2014, 2017 even, Treasury yield was above 3%. Stocks did fantastic. So this notion that stocks cannot do well as yields rise is utterly ridiculous. We think the bigger issue is that the Fed is creating a lot of confusion with their messaging, okay? Nothing changed in the Fed's policy position from when they actually met just over less than a month ago, about 3 weeks, and today, okay? Nothing changed. The minutes that we're getting are delayed from that particular meeting. Now, one big thing did change, okay? At the point that the Fed was trying to forecast where they would be in 6 to 9 months, which is a very difficult job, might I add, there was the expectation that we were going to pass a $3 trillion stimulus package, which did not happen, right? And if it does happen, it's going to be much smaller than $3 trillion. So you have to think for a second, put yourself in the role of Fed governor. You're worried about inflation. You think the government's going to pass another $3 trillion in stimulus, which would add to inflation. So naturally, you're going to project that interest rate hikes are going to be needed. Okay, fast forward to today, that $3 trillion of fiscal and monetary spending is out of the equation. Okay, if we get a stimulus bill, like I said, maybe $1 trillion. Okay, it's not going to be $3 trillion, right? Many of the senators that oppose this have already said, particularly Joe Manchin, that he will not support a $3 trillion spending bill. So this changes the course for the Fed, this changes the flight path, and it changes their outlook for the economy. Now, if we know one thing about the Fed is they do a lot more talking than they do doing, okay? And that's part of the game plan. They want to talk to the markets. They want to convince the markets that they are ready to raise rates if needed. That does not necessarily mean that they will do it. But if they do it, bring it on. The market can sustain it. It is just this constant uncertainty that's hanging over the market that is bothering stocks and creating a lot of fear and a void of buyers, right? As buyers on the sidelines say, you know what? I'm just going to sit tight until the Fed figures out what the heck it's going to do. And you have a lot of sellers rushing into the market trying to sell anything and everything that is not nailed down. So that's how you get days like today. So let's look at this. Let's put this in context. The NASDAQ here is still working in this wedge that we highlighted to you a couple weeks ago. It is very normal as markets go through a phase of bottoming and a readjustment to new information to see choppiness, okay? We've seen this before. The market is working within a range here. We do expect this range will resolve itself. We do expect it will resolve itself up to the upside. But let's take a step back and let's look earlier, last year now in 2021, very similar setup coming into March and April, right? I just showed you that last year, Treasury yields approached this same level, right, in March and April that we're seeing now, okay? And what happened in the market? We saw the NASDAQ race into an all-time high and then start to stumble, right? Then we had a relief bounce, another retest. The market tried to get its footing again, rolled over again, right? This is the point right here that we're at right now. This is when all the bears and all the prognosticators and all the narcissists and pessimists in the market come out and say, this market is dead, it's going back to the pandemic lows, and the best days are behind us. And then what happens, right? The market has a tendency to do the exact opposite of what everybody's expecting, and a powerful rally emerged in that, where the market then went on to run, another 20 or 25%, right? Here we go. Similar types of setup. We run into all-time highs. The market starts the first wave of a correction down, relief bounce, then a retest where we go back towards the low, another bounce, another retest. Okay, we can expect this to continue, right, for a couple more days, maybe another week, and that is okay. Every time we come on and do one of these videos and we talk about our expectations for the market to bottom, guys, that is not a singular day event. I just want to tell you that if you see us do a video and the next day the market is down, that it does not mean anything has changed in our eyes. Our outlook hasn't changed. Trust me, when our outlook changes, you'll be the first to know about it. Nothing has changed except price right now. The market is going through something. The market is working through something. And what I want to point out is something very interesting is the internals in this market, right? So the internal structures, the things under the hood, do not align with the price action we're seeing. So let me show you something called market breadth. Oh, wrong thing. And I want to show you that cartoon in a minute as well. But this is market breadth, okay? This is broken down by different sectors, and it's looking at the number of stocks advancing to new 52-week highs versus the number of stocks declining to new 52-week lows within a given sector at the same time. Now, as markets sell off on a day like they do today, you would expect to see more stocks hitting 52-week lows than stocks hitting 52-week highs. But when we look across these different asset classes, communication services, this one stands out very particularly as a software group that's been absolutely pummeled. It's like a growth apocalypse in this market right now. And yet, look, 52-week lows, we made a low about 3 weeks ago, and now many stocks are advancing in that particular sector. So this is a bullish tell in a bearish tape, right? And that's why we always talk about the indexes don't always tell the full story. So this is the type of stuff we're looking at. Consumer staples, again, breaking out, a lot more stocks hitting 52-week highs and lows. Financials, industrials, real estate, even technology, well off its lows, right? This was the sector that led the way down today, well off its lows, okay? But nonetheless, this is an encouraging sign to show that under the hood of this market, there are buyers, there is repositioning going on. So looking forward, expect the volatility to continue. Expect the market to continue to backtest some of these levels. This is quite all right. Corrections in the market are a feature of the market. They are not a malfunction in the market. Every time we get one of these, people look around and they want to know what's wrong, what's the problem. You know, somebody shut the markets off. We got a big problem on our hands. These are big declines. Believe me, we understand that. But in the context of what we're looking at, we have a market that has moved substantially higher. It has taken a few pauses along the way. This is nothing more than a pause. We do believe this market will regain its footing as the Fed gets more clear messaging out into the economy. And I want to end with a cartoon that somebody sent me that I think perfectly encapsulates what we're living through right now and the uncertainty that surrounds markets. And I'll read it today. It's a quote just in case you can't see it. And it says, on Wall Street today, news of lower interest rates sent the stock market up, but then the expectation that these rates would be inflationary sent the stock market down. Until the realization that lower rates might stimulate the sluggish economy pushed the market back up, before it ultimately went down on fears that an overheated economy would lead to a reimposition of higher interest rates, right? So it's just a giant circle here where the tail is wagging the dog, right? And it's nothing like price to change sentiment. Price goes up, everybody gets bullish. Price goes down, everybody gets bearish. It's a test as old as time, and it's not a head fake that we're going to buy. So remember, this is not our first rodeo. We've been through corrections before. Many of us have been through them together, side by side. We will get through this one like we've gotten through all the ones in the past. And on the other side of this, there will be some fantastic buying opportunities that we will take advantage of to add value to our portfolio strategy. So in summary, this is heartburn, not a heart attack. So keep calm and invest on. If you have any questions, reach out to us. Always here to talk to you about the things that are on your mind. We'll see you back on Friday for the Heritage Market Pulse. Have a great evening.